Welcome, everyone. Welcome to another episode of Wealth Talk. So, this week it's a bit calm. Trump hasn't dropped any new bomb. So, let's keep that topic aside for now and let's cover results, which we've wanted to do for many days. And of course, as we've been talking about this, revive E-CAS. Long ago, many investors and viewers were sharing their holding data with us, but very few people actually took action on it. So, not taking that action, or if they had taken action, how things would have been, and the implications of those decisions, we'll try to cover that as well, almost like a document. So, if anyone has ever shared their holdings with us in the past, let's outline how to use that, how to reference it, and what to do about it. So, first, before going into these topics, Prasad Garu, so that now we are in some calm seas. For many days, investors have been asking, if I want to invest now, which sectors should I look at? We've been saying, maybe if there's a heavy American export concentration, let's keep those a bit aside and look at generic kinds of companies which are away from this kind of sector. That's better, we've been saying. So, is this the right time to get into that sector? Or if Trump comes and reverses things a week later, something might happen. So, no need to take hasty decisions. Better to make decisions calmly and normally, right?
Putting Trump aside, what should we do? For our investors, it is better to look at companies in our country that are increasing profits and appearing at lower prices for buying. No need to worry too much about Trump anymore. Here, what we must remember is that recently, looking at Nifty and mid-cap in this competitive environment, both seem stuck in a tug of war. Mid-caps are not moving fast, and Nifty isn't moving fast either. Over the past 3 to 4 years, mid-caps have grown significantly and outperformed Nifty. So, according to our estimate, for the next 6 months to a year, large-cap stocks in Nifty will likely outperform mid-caps by about 90%. Therefore, what I am doing is applying two filters. First, I look for companies with a market cap greater than 20,000 crores. Second, among these companies, the ones with exports to the US of less than 5%. The meaning is these companies would not be affected even if Trump imposes another 100% tariff. Piramal Enterprises, current 1,122 rupees, fair price approximately 1,961 rupees, 75% potential growth. Central Bank of India at 36 rupees expected to reach 58 rupees, approximately 60% growth. Premier Energies, electric equipment, potential to grow 59%. Timken India, caution advised. Though shipments to the US are reported, direct exports seem absent, possibly due to local subsidiaries. Price is 2,836 rupees with potential to 4,527 rupees, 59%. But ground research recommended before buying. Diamond and jewelry, Kalyan Jewellers. Exports to US are routed via Dubai, so no direct US export impact. Price has fallen from 534 rupees to 851 rupees potential. Steel Authority of India Limited. Mostly domestic sales, minimal exports, less than 5%. Current price 120 rupees, potential 191 rupees. GOT CNC Automation, Defense, 918 rupees current, target 1,428 rupees. Schaeffler India, bearings, no clear export data to US, verify before buying. Price 3,858 rupees, target 5,968 rupees. Adani Energy Solutions, no US exports, price 776 rupees, target 1,200 rupees. Indian Overseas Bank, no exports, current 36 rupees, target 55 rupees, 54% growth. Lodha Developers, real estate in India, price 1,236 rupees, target 1,866 rupees, 51% growth. General Insurance, current 386 rupees, target 581 rupees, more than 50% growth. Overall, except for Timken and Schaeffler, which need caution, the other large cap stocks are solid. They have good potential for price and profit growth with low risk of sudden disappearance or severe losses. These companies present strong investment opportunities.
As Prasad Garu mentioned, we are focusing on limiting exposure to certain companies, particularly good large cap stocks. This is useful for our viewers as many have asked us to discuss large caps. In the coming weeks, we'll also talk about Vivekam's large cap growth product as we believe it's the right time to consider it. Before discussing Revive E-CAS, a quick note. Vivekam is a registered investment advisor, RIA. Neither our employees nor staff ever take custody of viewers or clients' funds or stocks. We mention this because imposters occasionally try to contact viewers pretending to be from Vivekam, asking for money transfers, promising intraday calls. Always report such cases immediately to the email info@vivekam.co.in and seek clarity before acting. Fraud attempts are widespread now, not only in financial services but other sectors too, so stay alert. We never ask anyone to transfer money to personal accounts, only to Vivekams for membership or building fees. Regarding Revive E-CAS, we've asked viewers to send their holdings to identify strong and weak stocks. We have received E-CAS from about 30,000 to 40,000 people, but only a small percentage acted on the advice to sell and move investments. Now let's ask Prasad Garu why reflecting on Revive E-CAS is necessary today.
When we started E-CAS, we offered help for portfolios with weak or poorly performing stocks. By sharing your E-CAS, we analyzed and advised which stocks to hold or sell, called switching, to improve returns. About 10-15% of clients who used this service asked questions, became clients, and earned good profits. Their portfolios are now strong, with fundamentals providing peace of mind. Around 85-90% belong to this group. For those who shared portfolios but didn't act, we urge you again. For example, a client who shared in June 2022 scored only 70 out of 100 on review. They had won 70,000 rupees in recommended holds and 6,000 rupees to sell switch but didn't act. This led to missing about 2,077,135 rupees in potential gains. Clients who acted earned about 24% returns versus 16% nifty growth. Inaction cost nearly 8% per year. Send your portfolio to holdings@vivekam.co.in with Revive E-CAS on WhatsApp. The team will assist you to take control and improve your portfolio.
Next, let's focus on results we delayed discussing. We'll cover some large cap and trending stocks. Many viewers have asked about LIC's latest quarter results. Sales and profits dipped slightly compared to the previous quarter, but trailing 12 months show growth, with new business up 20%. LIC is a major investment player, so investment movements affect their income. Overall, results are stable and good, but is LIC expensive or too expensive now?
LIC's main income is from life insurance, and it invests hundreds of thousands of crores in equities, acting as the backbone of the Indian stock market. Whenever strong stocks fall, LIC buys them and holds for years, showing no fear of price drops. Currently, LIC looks weak as sentiment isn't strong, and stock prices and portfolio growth may be low. The current stock price is about 887 rupees. Margins improved from 7.89% 2 years ago to 10.14% now. LIC is a must-have stock for experienced investors unless life insurance exposure exceeds 20%. Its market cap and leadership make it a safe buy. The fair price is near 1 to 200 rupees, indicating a 34% upside. LIC is a stock to buy and hold confidently without fear.
Next, focusing on Indigo, flight operators must be cautious given the current geopolitical situation. Rapid developments have forced companies like Indigo to revise plans. Indigo's latest quarter shows sales steady, but profits and net margins down 100%. Negativity includes risks like a possible Air India crash and tensions in Turkey and Azerbaijan affecting Indigo's investments and operations. Hence, it may be wise to keep some distance from travel-related stocks like Indigo now.
Whether to keep distance depends on if you hold Indigo stock. If yes, don't sell. It's a strong company with little competition in Indian air travel. Short-term issues like Boeing problems might cause impact lasting up to 2 months, but travel demand and Indigo's market position remain strong. Margins have slightly dropped, but profits rose from 5,600. Cash inflows add income, so fear is unwarranted. Buying now isn't ideal. The current price on 6,000 rupees is below the fair value by 21%, making it unsuitable for new investments. Hold if you have it, don't add new money now. Consider buying only if the price falls about 10% more, near 5,300, 5,200 rupees.
Right. Lastly, let's cover Mahindra and Mahindra. The latest results are very strong overall across sectors like autos, tractors, commercial vehicles, and passenger vehicles. All metrics, sales, margins, trailing 12 months show positive trends. Despite this, the share corrected slightly after results, possibly due to profit booking or high valuation expectations, but the correction was minimal. So Mahindra and Mahindra delivered strongly, but the question is it cheap enough for a good company or is it already expensive?
Selling because of one day's fall isn't suitable as fundamentals are strong. Mahindra's vehicles fit the Indian market with little competition from higher priced Tesla. Retail investors should buy when stocks are about 30% below fair value. Fair value for Mahindra is around 4,120 rupees. Current price is 3,265 rupees, showing 26% upside. Buying is better if it dips another 200 rupees for a 30% gap. Patience is advised. Hold if you already own it. Sell if price rises above 4,100, 4,200 rupees. New investors should avoid buying now.
Right, and with that, let's conclude this week. After many days, putting Trump and his policies aside, we got the chance to discuss other kinds of avenues. In the coming days, we will focus on some industries, about which industries to focus on or avoid, and as Prasad Garu mentioned about the portfolio score concept, what the next steps are, what corrective actions to take. We will definitely discuss. So with that, let us meet again next week. Thank you for watching.